Welcome to Stock Talk, everyone.
Glad to be here.
Today we're diving straight into Hilton Worldwide Holdings. That's ticker HLT, specifically their first quarter 2025 results.
Yep, they dropped on April 29th, 2025. We've got the key points from their earnings release sort of summarized in the Hilton stock analysis.
Right, and the goal here for you listening is really to get the essential insights fast. What are the key numbers, the main takeaways from Hilton's latest report?
Exactly. Cut through the noise, get to what matters.
Okay, so let's kick off with Q1 2025. The bottom line looked, well, pretty solid.
Yeah, definitely. Net income jumped almost 12% compared to last year.
11.9% to be precise, so that's $300 million.
Right, up from $268 million. And adjusted EBITDA was up too.
How much was that?
That's a 6.0% increase year over year.
Yeah.
Came in at $795 million.
$795 million. That's pretty strong growth, especially when they mentioned, those weaker macroeconomic conditions.
It really is. It kind of suggests they're managing things well, or maybe finding pockets of strength despite the broader economy. Resilience, maybe.
Could be. Okay, let's talk about rough pair. Always a big one for hotels.
Revenue per available room, yeah. Crucial metric.
So system-wide, Hilton's comparable rough PRR, it increased by 2.5%, and that's currency neutral.
Right. Important to strip out currency effects. And what drove that 2.5%?
Looks like a mix. Occupancy was up slightly, just 0.4 percentage points to 66.8%.
Okay, so more rooms filled.
And the average daily rate, the ADR, that was up 1.8%, hit $155.07.
So filling more rooms and charging a bit more per room, that's generally a healthy sign. Shows demand and some pricing power.
Definitely. Now, Hilton's also been busy building. Net unit growth was pretty significant.
How significant?
7.2% year over year. They added a net 14,000 rooms just in Q1.
Wow, 14,000 net. That's after any closures or removals, right?
Exactly. The gross number was 20,100 new rooms opened. That's across 186 hotels.
That's serious expansion. And what about the future pipeline?
It looks really strong. Their development pipeline grew to over 500,000 rooms. 503,400 to be exact.
500,000 rooms in the pipeline. That's huge.
Yep, a 7% increase from last year. It covers about 3,600 hotels in 123 countries.
And where are these mostly located?
That's interesting, too. Nearly half are already under construction, and actually over half are outside the U.S.
Well, a big international focus for future growth. Makes sense.
And while they're growing, they're also giving back to shareholders. Big time in Q1.
Oh, yeah. How much?
$927 million returned in total.
$927 million. Wow. How did they break that down?
The vast majority was share buybacks. $890 million spent repurchasing about 3.7 million shares.
Okay. And the rest in dividends?
Yep. $37 million payout in dividends, $7.15 per share.
That level of buyback, $890 million, really signals confidence from management, doesn't it?
I think so. It suggests they believe the shares are a good value and they're confident about future cash flow.
Right. Okay. Let's pivot to how different regions performed. Any standouts?
Definitely. The Middle East and Africa was the strongest performer. RevPAR up 8.5%.
8.5%. That's impressive. What drove that?
Strong occupancy hit almost 71%, and ADR jumped over 5% to nearly 203 growth.
So strong demand and pricing in MEA. Interesting. What about elsewhere?
The Americas, but excluding the U.S., also did well, 7.7% RevPAR growth.
And was that occupancy or rate driven?
Mostly rate. ADR was up 7.1%.
Okay. And the U.S. market itself?
More modest growth there. RevPAR up 2.1%.
And Asia Pacific?
That region was basically flat for RevPAR.
Flat? So quite a bit of variation across the globe then.
Absolutely. Really shows the different recovery speeds or maybe economic pressures in different markets. Asia Pacific's flatness, for instance, the report notes higher occupancy but lower ADR, so maybe some price competition there.
Could be. Or just a different market dynamic right now. What about specific brands? Any winners?
Oh, yeah. Spark by Hilton, one of their newer brands, had incredible RevPAR growth.
Oh, incredible.
26.1%.
26%. Wow. Okay, that's a standout.
Definitely. Waldorf Astoria also did well, up 10.7%, and Motto by Hilton was up 9.4%.
Interesting to see Spark doing so well. Suggests maybe that segment is hitting a sweet spot.
Could be capturing a specific type of demand. Now, let's quickly touch on the balance sheet. Debt.
Right. Always important. Total debt was $11.2 billion as of March 31st.
And the interest rate.
Weighted average rate is 4.77%. They also had about $807 million in cash.
And the key leverage ratio, net debt to adjusted EBITDA.
That came in at 3.0x, on a trailing 12-month basis. Pretty comfortable level.
Seems manageable. And they have plans for some upcoming debt.
Yeah, they mentioned planning to repay $500 million in senior notes due in May 2025. They'll use their credit facility and cash on hand.
Okay, sounds like standard financial management, and capital returns are continuing beyond Q1.
Looks like it. Through April, so including the first month of Q2, they'd already returned almost $1.2 billion.
$1.157 billion, yeah. And they reaffirmed the full year target?
They did. Still projecting around $3.3 billion in total capital return for 2025.
Okay, $3.3 billion, consistent message there. Finally, let's talk outlook. What are they guiding for the rest of 2025?
Well, this is where things get a little more, maybe, cautious.
How so?
For the full year, they're projecting system-wide RevPAR growth of basically 0% to 2.0%.
0 to 2%. That's quite a slowdown from recent years, isn't it?
It is. It reflects those weaker macroeconomic conditions they mentioned earlier, I suspect.
Yeah.
They're still projecting strong net unit growth, though.
Right, the expansion continues. What's the target there?
6.0% to 7.0% net unit growth for the full year.
So still adding a lot of hotels, even if revenue per existing hotel room isn't expected to grow much?
Exactly. They also gave guidance for net income, $1.7 to $1.75 billion roughly, and adjusted EBITDA between $3.65 and $3.71 billion, and reaffirmed that $3.3 billion capital return.
Okay. And any specific guidance for Q2, the current quarter?
Yeah, for Q2, they're expecting roughly flat system-wide RevPAR growth. 0% basically.
Flat for Q2. Okay, so definitely tempering expectations on the RevPay front near term.
It seems that way. Adjusted EBITDA for Q2 projected between $940 and $960 million.
Right. So let's try to summarize the key takeaways for you listening. It feels like a story of two halves almost.
How do you mean?
Well, you have very strong Q1 bottom line growth, really impressive shareholder returns, and continued aggressive expansion, both in openings and the future pipeline.
Right. Very positive on those fronts, especially the pipeline and international focus. Entering 27 new countries and territories is a big deal.
But then you have this cautious outlook for RevPAR growth for the rest of the year, even projecting flat for Q2.
Yeah, it highlights that resilience they showed in Q1, but acknowledges potential headwinds ahead. They're growing the overall footprint rapidly, which drives fee revenue, even if per-room revenue growth slows down.
It's a balance. Strong execution, expansion focus, but tempering near-term rate and occupancy growth expectations.
That sums it up pretty well. Gives you a good picture of where Hilton stands right now.
Okay, so here's something to think about as we wrap up. Hilton is clearly betting big on global expansion, adding new brands like Spark, even with economic clouds on the horizon. So, looking long-term, what do you think becomes the most critical driver for a company like Hilton? Is it keeping those occupancy rates sky high?
Or maybe pushing the average daily rate, getting more spend per guest.
Or is it just the sheer scale, winning by having the most flags on the map, generating those fees regardless of individual hotel performance?
Occupancy, rate, or scale. It's probably a mix, but the emphasis might shift depending on the economic climate. Something definitely worth considering as you watch the travel space.
Indeed, something to mull over. Thanks for tuning in to this deep dive on Stock Talk.